Hello. Um, Before we begin the part 2 of the review, I'd just like to remind you that I have deleted some slides from part 1 or from week 1 and week 2, and some slides from part 2, which comprise of week 3 and week 4. Most of the slides that I've deleted are the slides where you've got to do some calculations. Now, that's not to say that it will not, it's forever taken out of the exam context, but it will come out in the final exams. It's just that we would like you to focus on the concepts in this test rather than having to go through all the calculations and all. But keep in mind that those calculations will come out in the final exams. Those are the calculations where, you look at what happens if there's an extra contract, what happens if there's a change in basis. We won't do that in the test, but we will do that in the exam. Okay, let's carry on with part 2. We'll review week 3 and week 4. In week 3, we looked at understanding futures. The learning or the lecture objectives were to understand the basic concept of commodity swaps. We looked at commodity swaps. We looked at futures contract and had a deeper understanding of the mechanism of futures contract. And we looked at futures and hedging again to solidify our understanding, which we actually covered in week 2. At the end of lecture, at the end of week 2 lecture, we did look at futures a little bit, but we look into in more depth in this lecture, in lecture week 3. Commodity swaps. What you need to know about commodity swaps, it's an agreement between two parties where they exchange one set of financial obligation with another. It's a floating price of a commodity for a fixed price commodity, and that's what I want you to remember about commodity swaps. And NAP does commodity swaps. So the definition of a swap is an agreement between the bank and the producer or consumers. Remember, and when you're hedging, you can either be a producer or a consumer, and you take different positions when you hedge. That fixes a price of an agreed quantity of the relevant commodity on a future date. It is cash settled. This is very important. Commodity swaps are cash settled, and it's based on a commodity reference price. Okay, the commodity reference price can be any futures contract price that the bank uses, and it is the floating swap price for a relevant commodity price based on, as I said, futures exchange for the reference price for futures exchange for that particular commodity. So it might be a cotton futures from CBOT or wheat contract from CBOT. Now that's agreed before you sign a commodity swap, and it's cash settled based on the difference between the current price, the cash price, and that commodity reference price. Okay, if you look at a producer's perspective for commodity swap, the idea of a producer going into a commodity swap so that he can fix a price on whatever he's going to buy in the future. Whatever he's going to be selling in the future, because he's a producer, he's a farmer. He plants cotton, he plants wheat, and he wants a fixed price. He doesn't want to incur any price volatility. Therefore, he's managing his price risk. I did say that I removed all the calculations, but the simple ones I've kept in place, and this is one of them. I want you to know about how commodity swap works. It's very simple. If you look at this example, it's a producer in a scenario where prices fall. The one thing that you would want to know, or you need to know, is who pays. Whether if it's a producer going to the commodity swap, is it the producer who's going to be paying the bank, or is it the bank that's going to be paying the producer? So in this case, it's a producer's commodity swap. He's trying to protect the price of his future produce that he's going to be selling to the market. So if the price falls and the fixed price is, for example, $100, and at maturity the bank looks at the commodity reference price. It can be from Chicago Board of Trade, or it can be from a different futures exchange and sees that the price is at $80. So what happens is that the bank will have to pay the producer the difference in price. Okay, so essentially what happens is that the price is fixed for the producer. Now, in the event that the price rises, for example, now they fix the price at $100, and at the end of maturity, say 3 months from after signing the agreement, when the time when the producer is going to be delivering his produce, and they look at the commodity reference price at maturity is $130. So the prices have risen by $30. Now, what happens is the farmer still gets $100, but now the producer will have to pay the $30, the additional $30. All right, so he gives up his right to get profit from an increase of price for the ability to protect his price at $100. Okay, now that's from a producer's point of view. Now, from a consumer perspective, now consumer is basically like a manufacturer. Now, what happens is that a consumer is one who needs a product in the future, so he wants to fix his price for the quantity of product that they might require. They might need to use. It might be corn, might be wheat, it might be any commodity that they might need to use in the future. So, in a consumer's example, if there's a rise in price rather than in the producer's case, it's different. But in the consumer case, it's NAP that has to pay the consumer if there's a rise in price. You can go through the example. I'm not going to have to go through one by one, but I think you understand the basic concept now. And in the event the prices fall, the consumer will have to pay because they fixed it at $130. Sorry, they fixed it at $100. Now the consumer, and at maturity, when the price drops to $70, meaning the price is now cheaper, it's the consumer that has to pay NAB. There's this difference between a consumer and a producer, as you guys know, because it's the basic idea behind it is very straightforward. A producer wants to sell in the future, a consumer wants to buy in the future. Hence, the difference in when prices fall. In one scenario, the producer pays. In one scenario, one pays the bank, and the other scenario, the bank pays the person on the other side of the contract. So it's important to know on what side of the market you are at, whether you're buying in the future or you're selling in the future. That determines what sort of a hedging position you take. And we looked at futures contract. And that was the end of commodity swaps. That's all I need you to know about commodity swaps. And when we looked at futures contract, we looked at we defined what a futures contract is. I remember in the earlier part, the first part, we looked at the difference between a forward and a futures contract. A futures contract is a legally binding agreement, right, to sell a specific quantity or quality of commodity at a specific price and time in the future. All right, so all the specifications of the agreement are homogeneous. Now, the primary function of a futures contract is the discovery of price, where supply meets demand. It's also a risk shifting mechanism, from the speculators to the hedges. From the hedges to the speculators. And it allocates supply to given demand. It basically rations available supply, and it establishes deferred delivery and deferred prices as well. And the last point, which is the point that we discussed earlier, was it's homogeneous with regards to the contract size, delivery date, and location. It's all fixed. Unlike forward, where you can negotiate between different contracts. It can be different in different contracts, but not futures contracts. They're fixed. And there are 3 types of futures contracts. There's deliverable contract, where you have to deliver on it. You've got cash settled, where you cash settle just like commodity swaps, and you've got the over-the-counter futures contract. I want you to understand the futures terminology. There's a lot of terminology that you need to remember. That is woven essential. If you're going to be working in the commodities market, these are things that you need to know. Terminologies that you need to understand. Contract specification is straightforward. You know, the different contract specifications. Before you actually do a hedge, you need to understand the contract specification. These are what determines, you know, when it's delivered, what type of quantity, what type of quality, and so on. A clearinghouse, we've looked at what a clearinghouse is. It's what stands between a buyer and a seller. Broker, somebody who facilitates our trades. Daily price limits, that's where how much a price can move in a day. Tick size, I know a couple of you asked me in the last time, what is a tick size? Well, tick size is the movement of price, the minimum movement of price, and a settlement price is at the end of the day. That's just, you know, and when it closes, when the market closes, it says this is the settlement price, and it can be the last price of the day, or it can be an average of the last 5 minutes or 10 minutes. First notice day is a time frame where the seller issues notice to the clearinghouse, or the clearinghouse issues notice to the buyer. Okay, to say when the physical delivery is going to take place, or indicating whether he wants to deliver. And the delivery period is the time period where it must be made or taken. You know, if it's the seller, he has to make the delivery, or if it's the buyer, it's when he wants to take the delivery of the product or the commodity. Novation is an important concept in futures market. It's a process where, you know, buyers and sellers can liquidate. I can buy a contract. Francois might be selling a contract, but doesn't necessarily mean that we are trading with each other. I can just close my position. It doesn't have to be with Francois. Alright, it'll be liquidated with anybody in the market, you know, with different parties. And that's novation. And carrying charge is a set of intertemporal prices. We'll look at this in a little bit more detail in week 4. We looked at it in week 4. It just reflects a return for storage or a carrying charge. And it sets the deferred prices for distant month. You know, the increase in prices, contango and backwardation. We'll discuss that in a couple more slides. A nearby contract, straightforward, that's the closest month. A deferred contract, those are the contracts forward into the future. Contango, deferred contracts that trades at a premium, you know, as the prices rise in the deferred months. Or backwardations, where the prices actually falls. Or it doesn't where the prices of future contracts fall. So the nearby contract is the one that's trading at a premium. Initial margin. I don't know what initial margin is. It's you know, when you want to start trading, that's the first amount of money that you need to have to initiate your position. Your maintenance margin is the minimum amount of cash that you must have in the account once the position has been initiated. A margin call is when the broker calls you, and variation margin is the amount that you need to deposit in order for you to hold the position. Okay, we've looked at how you place orders in the futures market. There's an open outcry system, and there's an electronic based system. And we've looked at videos on both of this. Okay, other trading futures terminology now. These are when you want to trade futures, you need to understand what a market order is. I think everybody knows now that once you've played with, you've interacted with Commodity Challenge, a market order, it's filled there and then at the prevailing bid and offer price, depending whether you're selling or buying. GTC is good till cancelled. You know, the order remains until you cancel it. A day order basically gets cancelled at the end of the day. Stop loss is if you're buying, you wanna defend yourself, I'd say, against the market falling. Yeah, because you lose your money if you're buying, and then if the market falls, you lose your money. So you have if you bought at $100, you might have a stop loss at 90. You know, if it goes to 90, you say, yeah, close my position, I'm out, and I'll take my $10 loss. And OCO is one cancels another. You know, I've discussed this. You can hear in lecture. It's about having two different positions. If you bought at 100, you might say, I want to have a stop loss at 90, and I want to take my profit at 110. You know, so you're willing to take a loss of $10, and you're looking at taking a profit of $10. When one gets, you know, either you make a profit or you make a loss, the other order gets cancelled, so you don't end up opening a new position. Market on open and market on close is straightforward. It's about executing a position when the market opens or when the market closes. Okay, I want you to remember this chart. Okay, this is The position when one takes a short position, this is your profit and loss profile. So you make a loss when the prices go up, and you make a profit when the prices go down. And when you go long, or you buy a futures contract, the prices rises, you make a profit. If the prices go down, you make a loss. Okay. Now, there were a lot of categories of hedging in the class slides. I just want you to remember three, which are very important to what we've done over the weeks. Is arbitrage hedge, profiting from basis fluctuations or difference in prices in different markets. Operational hedge, a producer and a manufacturer would do this. They would want a fixed price for either their produce or for their inputs that they're going to buy. And a cross hedge. A cross hedge is, the example I used was like an airline. They use jet fuel, but they use a crude oil, which is a different type of oil. But because the price is pretty much correlated, you can hedge that in that way. So these are the three things I want you to remember: an arbitrage hedge, an operational hedge, and a cross hedge. Well, this is about a perfect hedge. We looked at the perfect hedge. I want you to remember this as well. Okay, it's got nothing to do with the amount of contracts or fluctuation in basis, but it's just looking at a perfect hedge. I will give you an example. You will have to convert. I'll give you the Australian dollar price. I'll give you the conversion for the tonnage, and I'll probably ask you, when I'll give you an example. For example, that in May, and then in November, in May he's got a cash position and he sold a futures contract, and then in November, and what's the amount of loss that he's taken in the futures contract, and what's the amount of loss that or gain that he's getting that he's gotten from the cash market. So this is an example. Have a look at this one. I will give you the figures. All you need to do is calculate it. So these are the only two calculations that I've kept, apart from all the other ones that I've removed. One was the commodity swaps, and this one is the example of perfect hedges. Where you gain $30 in one market and you lose $30 in one market, and effectively you've fixed your profit. Okay, this is a scenario where the market rises. Right? You can have a look at this one in your own time. The example will not be very difficult. It'll be specific. It'll be exactly like the slides. All right. So just know how to convert the US dollars to Australian dollars, and converting bushels to tons. Okay. We looked at hedging, and we said the two things that play an important role, which is the basis and the number of contracts. Hedging manages price risk, but in return you incur basis risk. And basis can change unfavorably and unpredictably during the lifetime of hedge, which will affect your hedging position. Some of the factors that affect basis are seasonal factors, weather conditions, temporary scarcities of commodities. There's a temporary shortage, and that's when you get contango and backwardation. In this case, a temporary scarcities of commodities, you'll get a backwardation where the current price will be higher than the deferred contract. And then availability of storage and transport facilities, the carrying charge that affects that, and the cost of storage and transport facilities. That's the same. That's the cost, and the other one's the availability. Sorry, we looked at commodity price relationships, and we also looked at how you use information. So what we're going to do now in this part, we'll look at the commodity price relationship, which was the first part of the week 4 lecture. Futures and options market. In this case, futures market establishes prices across time. The nearby contract and the deferred contract gives you a price into time. Commodities are basically an intertemporal price relationship, between the nearby and the deferred contracts. The spread between the futures and the delivery month, the amount of difference in price of the different contract months, And commodities are storable. Now that's what influences this relationship. So storage, or known as carrying charge, links the commodity prices between different months. So they're the main link. This is an example of a contango market, a positive carrying charge. It just shows you how prices increase as you go further into the different contracts. Some notes in contango. It's not the expectation that prices are going to increase. It's because of a carrying charge. That's why it happens. So large crop results in large stocks, and this generally equates to lower prices and larger carrying charge. Okay, it's typically referred to as normal carrying charge market because that's what you normally see in the futures market. All right. In some instances, you will see backwardation, a negative carrying charge. This is what happens when the deferred contract is priced lower than the nearby contract. And it's basically saying that, the market's sending a signal. It says here, it's sending a signal to say, look, sell your stuff, sell your inventory, because premium are paid if you sell your produce now. If you carry it forward, you're not going to get any returns or any positive returns, and there's normally a temporary scarcity of stock. Unlike positive carrying charge, there's no theoretical maximum value that you can estimate, and stocks will be carried. But the only reason stocks will still be carried despite not providing a positive return is because that producers or consumers will still need to produce stuff, right? So they will need to still have stock, and smaller crops will normally results in smaller stocks, and this generally equates to higher prices and smaller carrying charges. Okay. Carrying charge are basically determined by trading activity. It changes daily. It can be either positive or negative, depending if it's backward. If the market is in contango, then it'll be positive. If it's in backwardation, then it'll be negative. It provides signals or incentives to store or sell later. That's in contango. Or price it and sell it now, and that's backwardation. It basically tells the merchandiser, processors, and exporters what the market will pay for storage. Okay, that's for the first part in week 4. And the next section that we did was on fundamental analysis and technical analysis. I want you to remember 3 theories. Okay, the first one is a theory of random walk. What you would want to know from the theory of random walk is that you basically can't predict future prices from past patterns. Okay, that's what I want you to remember from the theory of random walk. You cannot predict future price patterns from past patterns. Okay, because the price changes are so random. Efficient markets. Well, in efficient markets, remember there's a strong, weak, and semi-strong. And in an efficient market, basically it reflects all available supply and demand information. And a really strong one, it also includes inside information. But in reality, market seems to be partially efficient because it reflects imperfect information and reflects other influences, other than fundamental information such as emotions. And in a partially efficient market, right, you want to beat the market, the trader must use existing information, that the information that you have now, in other way than how other people are using it. You got to interpret it more accurately than others, and you got to anticipate changes in non-informational aspects of the market. Might include emotions and stuff. Okay, we looked at fundamental analysis. Fundamental analysis is a forward-looking method. It attempts to determine the intrinsic value of a company. Now, this is when you're doing, if you're looking at stocks and you use fundamental analysis, the main thing that you're trying to get out of your analysis is the intrinsic value, and it assumes that the long-term intrinsic value will be reflected by the company's value. So, in the case of a stock, or if you're looking at a company, you'll be looking at the company's earnings. You'll be looking at ratios. You'll be looking at numbers that will eventually give you the intrinsic value of a company, and it focuses on the underlying business of a company. Now, you've got 2 separate things that you look at: quantitative data, which are the revenues and the assets and the ratios, and you've got qualitative data, which you look at proprietary technology, the experiences of the management, are they good? And the overall marketing strategy, these are some things that you can't put a number on. And well, that's fundamental analysis from a company point of view, or when you're investing stocks in stock. But from a commodities perspective, the difference in, the the, the thing that underpins a fundamental analysis in commodity from a commodities perspective is basically supply and demand. That's what you look at, right? Those are the ratios that you want to look at. Those are the quantitative and qualitative data. All basically boils down to supply and demand. It's an approach to market analysis that uses market data about supply and demand to evaluate commodity prices. Okay, so the larger the demand, if the demand is larger than the supply, then you get higher prices. If the supply is larger than the demand, then you get lower prices. That's the basic understanding of supply. From a commodities perspective, if you're using fundamental analysis, you'd want data on production, on stocks, how much in stocks or inventory, and then you've got on government policies or political factors that might affect the market that you're in, or if you're a producer or a consumer. And all this information are broken down into supply and demand. And supply and demand elasticities become important in your analysis. Those are the things that you need to take into consideration. We look at law of demand, where the market demand equals the sum of all the individual demands, and demand is affected by price, handling, packaging, and quality. So in order for you to understand demand, you need to understand consumers' behavior towards a particular commodity, elasticities and stuff. And the demand of agriculture commodities basically derived from the demand for a finished product. From a fundamental analysis from a commodities perspective, some of demand side information that you can use are US export sales, China's import data, the global crude oil consumption, and income growth. So these are all data that will reflect demand. We looked at the law of supply, where market supply is the sum of all the commodities that's being brought into the market, and supply is affected by weather, price inputs, and technology. And in order for you to understand supply, you need to understand the producer's behavior towards producing and selling a particular commodity. And supply equals production plus carryover stocks. That's the amount of supply that you have in the market. Some of the example of supply side data that you can use, or supply side information that you can use in formulating your fundamental analysis. You can use winter wheat seedlings, prospective plantings, weekly weather, and crop bulletin. These are all factors that will tell you how much, the amount of supply. The first two will say, will give you an estimate of how much supply there's going to be, and weekly weather and crop bulletin will eventually tell you what's going to affect that supply. So it's a combination of data that you need to use. The advantages of fundamental analysis: it's objectivity. It's got sound methods and ratios, and numbers that you can look at, numbers that you can weigh and compare against each other. And it's got a long-term focus. In the long run, markets are driven by fundamentals. And value, when you have an intrinsic value, it helps to determine the buy price, and it gives you an increased understanding of a particular commodity that you're looking at. Some of the disadvantages of fundamental analysis, how do you separate between fact and rumor? You've got all these blogs and all this bombardment of information that comes out. You need to separate from the truth and the facts, from the truth and the hype, and because the data is overwhelming, and then facts are often soon discounted into the price. That's where you get buy rumor and sell the fact. It's time consuming. If you're going to be doing cotton, you've got to do a lot of analysis. You've got to understand. It's constrained. Knowledge is focused. You can't go, if you understand cotton, and if you want to go wheat, you've got to take about the same amount of time, maybe more, to understand wheat. And it's affected by market sentiment. There's market sentiment, emotions which you can't incorporate into your analysis. And there's a time lag between report performance. By the time you exit this trade, once the information is already, once you've gathered the information, it's already happened, which is about the same thing as facts are discounted into the price. It's based on assumptions. How do you value political change? And data comes from companies, and I gave an example of Enron. We looked at technical analysis. Technical analysis is, the theory of random walk says, this is not possible at all. That's theory of random walk, remember that? It's predicting future prices based on historical price performance or behavior. You study the price movement. When fundamentalists analyzes the reason behind the movement of prices, chartist analyzes the price movement. Okay, it's based on three assumptions. That price reflects all information, all supply and demand are reflected in the price movement. Price movement trends and price patterns are repetitive. Remember that. It's technical analysis. Those are the basic assumption of technical analysis. Categories of technical analysis. We've divided it into four. Looked at patterns on price charts. We'll look at bar charts for that one. And the second category is the trend following methods. Moving averages is an example. And we look at character of market analysis using oscillators, those overbought and oversold lines. We looked at the relative strength index. And there are long structural theories, the waves, takes years to build. These are bar charts. I'd like you to remember the open, high, low, and close when you're looking at bar charts. Open, high, low, and close is very important when you're doing, when you're hedging. Those are the ones that tells you, which describes the price movements of today and yesterday as well. I've deleted the candle charts of the slide, so you don't have to know about candle charts, but I want you to know about bar charts. Support. What is the support? You can explain that to me. It's very self-explanatory. And resistance, we looked at that for chart patterns, and we look at trading range, right? So this is the trading range. It moves between the support and resistance. On the second category, the trend following method, we looked at moving averages. I gave you an example of a moving average. If the bars cross over the moving average, you buy. If the bar crosses under the moving average, is a signal to sell. That's a simple way. That's a simple technique of moving averages trading technique. And then we looked at the character of market analysis, or the oscillators, where the overbought. This is the example that I use, a relative strength index. I think what you want to remember about oscillators, it uses overbought and oversold lines to determine where they want to buy and where they want to sell. That's what I want you to remember for oscillators, okay? The overbought and oversold indicators. And that determines when they buy and when they sell, okay? Long structural theories. Elliott wave is an example. It takes years, it looks at waves. It's 1, 2, 3, 4, 5, how the wave, and then which wave you're in, whether you're in wave 2 or whether you're in wave 3, that determines your trading stance. It's a longer term look of the market. That's the four categories of technical analysis. I want you to remember the advantages and disadvantages of fundamentalists and chartists as well, or technicalists. For technical analysis, the advantages it gives you an entry and exit signal. It tells you when to come in and when to sell. It's easy and straightforward. You can apply it to a wide range of commodity. You can use it for commodity. I can just open up a wheat chart and I can open up a commodity without having to understand the fundamentals behind it. I can start trading. All I need to do is I need to have a basic understanding. Of course, you'd have to learn what all the different types of techniques in technical analysis before doing that. But once you know that, then you can apply it to all different sort of commodities. It can be performed relatively quickly. It does not use any financial statement. And it takes market sentiment into consideration because you're studying price behavior, historical price movements that reflects market sentiment, and it's relatively inexpensive. The disadvantages of technical analysis is that the past does not always indicate future results. That calls into question, and of course it violates the premise of the efficient market hypothesis as well. The technical analysis is subjective, not objective, like fundamental analysis is. It cannot be used to make consistent decisions. Things change, behavior changes over time. Signals that indicate action in technical analysis also will change. Today it might be generate a buy signal, but several months down the road, that buy signal might be different, and it shows that it affects price, the volatility of price. When people use technical trading and they use software to generate their buy and sell signals, it creates unwanted volatility in the market. And there's just too many indicators out there. You've got moving averages, different types of moving averages, different types of applying moving averages, and it does not take into account underlying fundamentals. Remember, fundamentals is good for the long time frame. That's in the long run, it affects market fundamentals. So when you're using technical analysis, it doesn't use fundamental analysis. So that's a disadvantage. Thank you very much. If you've got any question, please contact me or Francois, or you can send me an email, and I'll get back to you as soon as possible. And if you do need to talk to me, we can Skype, not for an hour, maybe 10-15 minutes, just to get some stuff cleared up. Good luck for the exam, and thank you very much, and good luck for the presentation after this. Thanks. Bye bye.